Hey guys, it's Tyler. What's going on? Hope you're all staying safe in this nutty market sell-off. In today's video, I'm going to talk about thinkorswim and how to analyze options within the platform. We get a lot of questions in the comments. What do you look for in an option? How do you use the thinkorswim platform to do it? So I'm going to debut that tutorial today. But first, before I do that, I got to remind you guys, please go look at the Value Ventures newsletter. This is a brand new product from Macro Ops written by Mr. Bean. And this is going to be awesomely full of stocks that he thinks are going to fly in the next few years. He's a really good value investor. He's going to teach you all the nitty-gritty fundamentals. And if you like this style of investing, or if you're even just interested in this style of investing, check this thing out. It's really going to help you get to the next level. And all you got to do is click the link in the description. You'll bump out to this page right here, read all about it, and go and sign up. Now time for options. Okay, so the first thing I want to introduce you guys to is called the options chain. Now, if you go and look at the platform right here, I'm going to type in Tesla, T-S-L-A, and you're going to see that pull up. And what loads down here is called the option chain. Now, what the option chain is, it lists all the different expiries for the options. And then if we click into a expiry, let's do this September 20th, 2019 one, you're going to see all the different options at the different strikes here. And what you can do is you can select 14, I think is default right here, and it'll show you the at the money options. So Tesla's trading around 220, so that's the at the money. And then the 14 options, 7 above, 7 below. If you want to change it to all, sometimes I like to look at all so I can really look far out of the money here. You're going to be able to see all of the options listed. So all the way down to, until they don't really have a bid in the 45s on the put side and on the call side, all the way into these basically fantasy options up into the 400s. Okay, so the critical thing when you're first looking at this is switching to layout, volume, open interest. And the reason is because not all options have a lot of liquidity. And before you trade an option, you want to make sure that you see a decent amount of numbers over here. There's some volume flowing through the option market each and every day. Because if not, you're going to end up with options that have extremely wide spreads. And wide spreads means you have to pay up a lot to get into the trade. The market makers make a ton of money. You don't make a ton of money. So the first thing to check whenever you're trading an option is to go into here, select layout, volume, and open interest, and then go in and make sure you have a lot of open interest and volume. Let me show you a quick example of what something looks like if it doesn't have any volume at all. So for example, I'm going to pull up Front Door, which is actually a stock our resident value guy, Mr. Bean, has been talking about a lot. And this stock, it doesn't really have an active option market actually, which is why we're working with trading with the underlying. So if we go to the October options and we pull out volume, open interest layout here, you can see these are zeros and twos, ones, zeros, not much going on. And then look at these spreads. So for example, the 55, you got 155 by 190 over here, 180 by 205. An option price, that's almost 10% of an options price in giving up in the spread here, and that's a lot of money to give up, a lot of money that the market makers will be making off you. So in general, if you see the volume open interest column at zeros, then you're going to want to avoid trading those options completely. You're just not liquid enough to trade. Now let's go back to Tesla so we can look at a liquid option market here. Boom, pull up Tesla. We're going to look at the OCS again, OC 18 2019, 65 days to expiry. And we're going to go to layouts, and this is the other very important one I like to look at. I like to look at implied vol, probability, OTM, and delta layout. So after I look at the volume open interest, I click on here and I go right down here, and you're going to see the implied volatility values for each option, the probability out of the money, and the delta. Now let me quickly explain what each of these columns mean. Implied volatility is essentially what percentage of volatility that the option is implying in the stock. So if the number is very, very high, that means the option market is saying the stock's going to move around a ton. If the option is implied volatility is very low, it means the option is going to be cheaper, and it's going to say that the stock isn't likely to move that much up or down. So this column is very important right here. If you're really wanting to get into options, you need to understand implied volatility, and in general, you need to know when something's a buy and when something's a sell. Really, really high implied volatility is usually a sell. Really low implied volatility is usually a buy, but it depends on what the underlying trading, right? Corn or S&P 500 is a lot different than Tesla. But this is definitely something that you need to start paying attention to. The next one is probability out of the money. And all this means is what's the probability that this option expires worthless. So let's go to the call side here on Tesla. Let me back this out a little bit into the all so we can see some really out of the money options. And you can see here, let's go to this 280 option. The probability that this thing expires worthless out of the money is 91%. So right off the bat, these give you a rough basis of what's your percent chance of making money. Now, this is the efficient chance of basically the line of whether or not you're going to make money. Now, if you can buy this 280 call and it's going to expire, out of the money only 80 or 70% of the time, then that's an edge and you can make money on that purchase. But in general, if you didn't have an edge, you're just to go in and buy these options randomly, you'd expect stuff like the 280 to expire out of the money around 91% of the time. Now, the next column is delta, and what this represents is per dollar move in the stock, how much the option moves. So if Tesla moves up $1, the 12 delta calls will move up 12 cents. Then as we get closer to the money, the delta gets larger and larger. The one thing I do like about delta that I want to point out is if you just want to look at deltas really quick and not deal with this probability out of the money section, these are a good estimator for the chance that this option has to make money. And let me switch this column over here to probability in the money, and that's going to make a little more sense for this comparison here. So this is an old option floor trader rule of thumb thing. So if you go down, let's say the 23 delta calls, what the floor trader should say is, all right, 23, it has about a 23% chance of making money, of expiring in the money. And you can see here the actual probability is around 17%. So it's not perfect, but it's a good rule of thumb on the fly if you want to quickly look at something. Let's look at the put side and see what it's saying over here. So if you go over here to the 160 puts, we have a delta of 10. The probability of in the money is 15%. So yeah, it's about 5% off, but it's still a very good estimation. Let me try to find something else, another thing here that might show even tighter estimations than Tesla, because depending on the underlying, you could really have different discrepancies and errors going on. So let's scroll down to the SPX here, and there's a ton of options on SPX. So let me get down closer. Boom. So you can see these are a little more in line here because the SPX is a very tight market. It's not a single stock. And the 25 deltas, 27, 26, 28, very similar. 33, 35. So remember that little hack right there. If you just look at the delta and you're saying, I'm going to buy an out of the money put on SPX, and you're buying something that says a 20 delta put, then you can expect that thing to only make money around 20% of the time. If you did that trade over and over and over again. Now, if you're making money 30% of the time, then you're doing better than what the market's implying, which again goes back to this implied volatility number. All these numbers are related. I'm going to talk about that in another video. You would actually have an edge, what we call an edge of the market, and you'll be doing very well in option trading. So these are the key things to look at when you're first getting started off on trading. We got the liquidity, we have the volume open interest, and then we have this one, the implied volatility, probability out of the money, and delta. And then remember, you can change this column over here to probability in the money, and you're going to see that delta and probability comparison more clearly. Okay, now the next tab is called the Analyze tab, and this tab's awesome. I really got into this tab when I first started trading options way back in the day. And what this allows you to do is add a simulated trade. Say you're thinking about taking a put spread or a call spread, in SPX. Let's look at that one. You can select it on here, and then you can go in and look at the payoff profile and then tweak some parameters to see, okay, how will the payoffs change? How will my P&L change as this trade plays out? So let me run through a quick example here. Let's say we're going to buy a call spread, the 28.45s vertical, and then I'm going to extend this a little bit longer down to the 28.80s. Okay, boom. We have a call spread here. We have a price, 20.45. Now watch what happens when we go over to the risk profile tab. So here is the profit and loss graph for our option. And you can see, today, right here where the SPX is at, in purple is the profit and loss today. And so right now, since say we were to buy it today, it's at 0 because we just bought it. The market really hasn't moved. This blue line now is what the payoffs would be at expiration. And so you get to see, if SPX maintained and stayed exactly where it was today, this trade would be down $20,450. But say SPX went up to 3,000, we would have a gain of $14,550 on this trade. So you get to see two things. You get the purple line is showing you what is the P&L today. The teal blue line is showing you what is the payout after this option expires. Now watch this. This is really cool. So one key thing with options is because we have this time effect within them. So the P&L changes dynamically. And a great way to see this and get it ingrained within your system is to go down to this little date tab right here and slowly just kind of tick this thing up as the trade plays out, pretend time's passing, and you're going to see how this purple curve plays out. And you can see it's slowly actually going to be converging into the blue line. And so what's nifty about this is you can see how this trade plays out over time. And you can also say, hey, let's say SPX gets to 3,000 on September 17th. What's my P&L? Boom, you go up here, you see $9,900. That's really awesome. Now, what happens if it it's a little bit later and it's 9:30? We go to 3,000 bucks. It's 11,620. So you can see that we have a very awesome way to look at how the P&L evolves over time, and this really helps you kind of figure out what option structures do as a trade plays out, and helps you basically develop intuition on straddles, strangles, all these complex option spreads, how they actually move as the underlying moves and time moves. Now I want to throw another simulated trade up here to show you guys another nifty thing about this. So if we move over to SPX, yeah, let's stick with October again, 28.45. Let's go to buy, and then let's go to straddle. I like straddle. So that's buying the call and the put, same strike, 28.45, 185 bucks, 95 cents. Boom, we got it loaded up here. Risk profile. Let's see how it looks. So you can see on the risk profile, we can go into here and we can see at current day now down money right here because I have the date set at 9/30/2019. So let's go back to current day. That thing should reset to 0. Boom, there it is, 0. So if we buy this thing today and the stock does nothing, we're break even in the trade because nothing has happened. But with the straddle, as time passes, as you guys saw, the prices of the options slowly decay, and in order to make up that decay, we're gonna have to have movement either up or down in the stock. So SPX just stays where it is. You can see now this straddle's down 51 grand. And as it keeps going down, keeps going down, keeps going down, now this thing's down 85 grand as long as it doesn't move anywhere. But let's say SPX tanks and it goes all the way to 2,600 at 929, then we're up 59,000 bucks. So that's pretty interesting. And then, you can zoom out and just see, what are all my possible payoffs with this thing. So this date thing is very, very critical. And now the last thing is very nifty. I want to show you guys because it helps you figure out how volatility moves the prices of options. So what you do is you go down this little gear right here, you click it, and then you see this little thing called vol adjustment. Okay, vol adjustment, that's what we're looking at. And you're gonna see right now as we play with this number here and pretend that these volatility prices go up, the P&L of the option our option spread is gonna change. So I'm gonna raise it right now, and you can see that the value of our straddle, even though the market's not going anywhere, so let's say SPX stays where it's at, the value of our straddle is going higher. Higher, 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 higher as this volatility moves up, because options have two components, right? We have the underlying, the price of the underlying, but we also have that implied volatility component. And so for Australia, you're long two options, so that means the longer volatility goes up, or the higher volatility goes up, the more profit we have in our option spread. So that's a really cool thing to see. And then you can also see the opposite, like let's say the market crashes, the market rallies and volatility crashes, the VIX crashes, and we have a negative 10%, you can see how much of a write down our long straddle would take. So even if SPX did nothing, it stayed where it's at, but we had a 10% drop in implied volatility, our straddle would be down 95,000 bucks. So you can play with these parameters, right? You have the date, you have volatility adjustment, they even have a little stock price adjustment here that you can do, but my favorite ones are the date and the volatility adjustment. I think those really help you see how an option trade plays out over time. It'll help you really get into your mind these P&L graphs, and that's how you become an expert options trader, is you have all this stuff downloaded into your mind, so you can kind of think through this automatically and go and know, hey, a few months time, the underlying goes up a little bit, vol gets crushed, I'm not really going to make that much money. And so you have these things just memorized, and so it's much easier to go through the option chain and pick out what your favorite spreads are. All right, guys, that was it for the mini option tutorial inside of thinkorswim. I hope that helped you get in there, mess with the functions, do what I did, and just play around with it. That's going to help you understand options at a much more higher level. It certainly did for me when I was first starting out. Now, before we go, once again, guys, check out that link in the description. Mr. Bean's Value Ventures newsletter. It's brand new. It's coming out. I really like what the August issue just got released. I really like what he put out. Even I'm learning a ton. I've been in this game forever, and this guy is so incredible at fundamental analysis that I learn something new every single report. So if you want to really learn about fundamentals, you want to learn about value stocks, hit the link in the description. Check this report out. And finally, if you like these videos, go down, hit subscribe, hit the bell. You guys know the drill. And that way you'll see when the next video goes live and I'm back to teach you more about options, stocks, trading in the market. Thanks a lot, guys, and I'll see you in the next video.